Hello, and welcome back to day 15. Today, we're talking about building a tax vault before April hits. So, yesterday, I walked you through the three account structures for building a budget for NIL money: taxes first, saving second, spending third. Today, I want to go a little bit deeper on the first account, the tax account, because setting that up is one thing, actually using it correctly is another. I call this your tax vault. And if you build this habit now, you will never be caught off guard by a tax bill again. So, what exactly is a tax vault? It's a dedicated bank account separate from everything else where you deposit your tax set aside the moment any NIL money lands. Not at the end of the month, not when tax season is coming, the moment the deal pays out. You move 25 to 30% into that account and you do not touch it. Do not touch it. The account has one job: to be ready when the IRS comes calling. And the IRS will come calling. So why does 25 to 30%, like how did we get to that number, right? Because NIL income itself is considered self-employment income, which means two tax layers hit at once. First, depending on what state you live in, you have federal income tax that's based on your tax bracket. Second, you have self-employment tax, which is somewhere roughly around 15.3% on top of that. Now, when you add those two together, most NIL athletes land somewhere between 25 and 35% of owed money, depending on their total income. And again, the state that they're in. So 25 to 30% is the safest floor to start with. If you end up owing less, that's a refund. If you set aside too little, then you're short when it counts, which means you're going to owe. So err on the side of more, not less. So when do NIL athletes actually have to pay taxes? Well, this answer surprises a lot of people. The IRS doesn't want one payment in April. If you expect to owe more than $1,000 in taxes for the year, the IRS expects quarterly estimated payments to be made. Those payments are due 4 times a year: April, June, September, and January. If you skip them, you don't just owe that tax. Now you're going to owe penalties and interest on top of that. Your tax vault should be funding those quarterly payments, not sitting untouched until the April filing deadline. So what if a deal came in as a Venmo or a Cash App payment instead of a wire? Well, it's still taxable. I know some athletes think that if it comes through a payment app, it doesn't count. It counts. As of 2023, payment platforms are required to send 1099-K forms for any payments totaling more than $600 in that year. So even if a brand paid you through Cash App, it's still reportable income if it was more than $600. This method of payment does not change the tax obligation. So then question 5, what about NIL deals paid in crypto? Glad you asked. That is also taxable. However, it's actually a little bit more complicated. Crypto NIL payments are treated as property, not cash, by the IRS, which means you owe taxes on the fair market value of the crypto at the moment you receive it. And if the crypto goes up in value before you sell it, you may also now owe capital gains taxes on top of the original income. Crypto NIL deals sound exciting. Just go in with your eyes wide open about what they actually cost. So what if an athlete already spent the money and tax season is here? Well, first, you're not the first person that this has happened to, and you are not out of options. The IRS has payment plans. You can file, acknowledge what you owe, and set up an installment agreement. It's not ideal, but it is manageable. What makes it worse is ignoring it. Filing late and not paying is a double penalty. So if you're in this situation right now, file on time, reach out to the IRS or a tax professional and set up a payment plan. Then build your tax vault so it doesn't happen again. So what's the one habit that makes all of this easier? Move the money before you see it is available. Every single time a deal pays out, before you spend a single dollar, move 25 to 30% into your tax vault. That's it. That's it. It sounds simple, and it is, but most athletes don't do it because they see the full amount land in their account and it already feels like it's theirs. So train yourself to not only see what's left, but what's left after your vault is funded. That mental shift alone will keep you out of tax trouble for the rest of your career and your adult life because the same principles apply, right? So the tax vault isn't complicated. It's one account, one rule, one habit. Move 25 to 30% of the money that you've made the moment it lands. Don't touch it. Pay quarterly. Every athlete who's ever said, I didn't know I owed that much, had the same problem. They had no tax vault. Build it now before the next deal comes in. Okay? So thank you for joining me today, and I will see you tomorrow for day 16. Bye.